Welcome to the CU 2.0 podcast.
Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
Wouldn't you like to make more and more profitable auto loans? Just about every credit union would say aloud yes, and that's why this episode is a must listen. On the show is Zach Eychaner, the VP of Digital Experience at ELGA Credit Union, a $1.5 million institution based in Michigan. Also on the show is Mitch Rutledge, CEO of Vertice AI, a Georgia-based company that says it provides actionable and measurable account holder intelligence to help credit unions offer their members the right products, solutions, and services at the right time. Sounds good? How to do it? How exactly to do it? Rutledge tells how on the show, and Eychaner gives the verdict about whether it's working at ELGA. Every credit union wants to know how to make more targeted loan offers and explains Rutledge the answers are in the data. The institution's data that it already has if it learns to mine it properly. Listen up. So let's start here. Auto loans, they're not as dead as I think they are. And their defaults aren't killing everybody. Is that true, Zach?
That is absolutely true.
So tell me about the experience at ELGA.
We continue to see auto lending and produce auto lending at a rate that is meaningful to our bottom line. It's still a core piece of what we do and how we make money here and how we support the communities that we serve, right? And the demand hasn't gone away. The default has not been anything that has caused us any concern or pause. We've been lending in the state of Michigan since 1953, and we've got a pretty good feel for the people that we're lending to and for the situations that they're in. So we don't really we have seen no material swings in default, charge-off, deficiency balances, or any of those kind of things. So it has just been something that has stayed a core piece of the business and what we'll continue to do.
Just ballpark, what percentage of your loan total are auto loans?
Greater than half. I know we do a decent amount of mortgage lending, some commercial lending as well, but it's probably around 50%.
Here, Mitch, so what's your role at ELGA and auto loans?
I'm the CEO and co-founder of Vertice AI. We're a partner with ELGA, and we've been working with the ELGA team for a couple of years now. Vertice is a growth and personalization solution that ELGA is utilizing to identify the best opportunities for growth within their existing member base. And that really comes through understanding the behaviors of their members. And we say try to find what are the needs and wants of the members and aligning those to the needs and wants of ELGA. You know, there's always this balance of deposits and lending and finding the right members to engage with about lending conversations at the right time and the right deposit opportunities at the right time is a fine balance. And there's lots of insight in the data that they have about their members. And we try to distill that into something they can understand and most importantly, action on, because insights without action is just trivia. And that's what we're really trying to empower Zach and his team to more efficiently find those opportunities to serve members and grow the credit union efficiently.
Now, more credit unions are waking up to the premise that they have a ton of information about their members that they've never really harvested or used. What is this information?
We'll start and then I think Zach can probably weigh in on this, but one of the, really key pieces of data that every credit union has, but is hard to harness is all of that transactional data that we have, right? All of the swipes, credits, debits that they're using their accounts for and where they're using them. It sounds like a straightforward data set, but it's very difficult to turn into something we can action. So I think that's one of the keys that we've done, as well as I think another key data set is, back to lending. In the lending data that we get, application data from members, we get a lot of really important insights into their, again, needs and wants, so that we can then engage them with relevant content, right? That's what we're really trying to do, is serve the members products and services and content that is going to make their life better and more efficient. And that's what we're trying to distill out of that data. So transaction data, application data, and just account data as well, right? Balance data is also valuable to understand needs and wants of members.
Now, if I were going to guess, I'd guess that my credit union has access to about 1/3 maximum, probably more like 25% of my financial transaction data. That's kind of a problem, isn't it? I mean, it's simply not, it's not that they have it and they don't know how to harvest it. They don't have it.
We believe that data is a journey, not a destination. And so Robert, what I would say is if they're not using even that 25 or 33% for anything, what does it matter if I have 100%? So our belief is, let's get you using what you have today, and then we can grow that with other data sources to continue to get that picture, right? So one of the things that we can get from transactional data is, where are you sending your money into other institutions, right? If we have some.
Absolutely. In my case, they see that American Express scrapes out a bunch of money.
Perfect example. Right.
Chase scrapes out a bunch of money for a credit card.
Right.
It's
third-party auto loans, where you send your mortgage. All of those are, for sure, there are pictures that you can distill from the data that they do have. But, I don't think would ever say that, yes, we're capturing 100% of the financial picture. But, again, that's a journey. So let's start with what we have and make sure we're maximizing it. And then we can go find third-party sources over time. But from our experience, more than 2/3 of the institutions that we talk to would tell you that they're not leveraging their first-party data effectively to serve members.
Oh, I hear that frequently from credit unions, the acknowledgement that people like you have told them they have a lot of useful data, but they haven't really figured out where it is and what to do with it. So not blaming you, but it's.
But I'll bring Zach into that. I mean, Zach, you're living this every day. I don't know if you have an opinion on the amount of data you feel like you have and how you're using it with Vertice and beyond.
Yeah, well, and I think that's where the results kind of speak for themselves on that one, right? When we do leverage the first party data that we have, the results are material and impactful, and really support the decision to not only leverage all the first party data that we can, but continue to inform that, providing additional solutions that would encourage our members to connect and aggregate some of the external accounts that they have as well, and that transaction data to help us have even a more complete picture. But like you said, it's a journey, right? We've got to start with what we have, and the results still are so meaningful that we can't wait until we have greater than half of that data even, right? If we've only got 20-30%, that still informs the decision overall, informs the strategy, and allows us to support people and meet them where they are more and more intelligently, and present things that just make more sense. And again, they convert, right? They see that, they take action on that. It's meaningful to them. It's super important that we leverage whatever additional information and data sources that we have to refine the communication, refine those messages, and get those results.
Are indirect auto loans a significant piece of your portfolio?
They are, and they have been, but that was an area that we used to pursue a little heavier, even through 21 and 22. We made a mindful shift to really focus on getting deeper relationships long term, and indirect relationships are hard to expand, they're hard to build, they're more transactional by nature, and so they're deprioritized, but they still are a large portion of the overall portfolio.
Well, what's the ratio of new car loans to used car loans, and has that changed? I mean, I saw a stat the other day. I might not remember it quite accurately, but it's like the average price of a new car today is 55,000, something like that. And I was thinking, I have two neighbors who historically always bought new cars, who now have rolled up with used cars from dealers, like 2 years old, really nice condition cars. I'm thinking, am I seeing a trend where instead of paying 55, they're now paying 30 or whatever they paid? It's I mean, are you seeing any shift in your ratio of new to used?
Not really, because we've never been strong in the new vehicle purchase game, right? That has been something that we don't really compete and try to compete on the lowest possible rate. We get financing via manufacturers still at 0%, 1%. So those are ones where we don't typically pursue those and aggressively go after those, because we're really good in the used space, and credit unions, I think, historically have been really good at used and have really stepped into that spot that can be meaningful and can make that difference. So we haven't seen a large shift, but we don't have a large portion of our portfolio that resides in new purchases. A lot of times it's a used purchase that we're seeing.
I understand that. The one and only time I had a pre-approval letter for a car loan from a credit union, I went into a dealership. Guy said, "Okay, finance manager, you go talk to him." And I said, "No, I already got pre-approval. I don't need that." And he said, "We can beat the rate." And I said, "It's a really good rate." He said, "We can beat it." I said, "What's your rate?" He said, "0." It was a buy down from Subaru, and Chase was carrying the paper, but it was 0% for 4 years. It's couldn't beat
Hard to
that
say
rate.
no. Yeah, exactly.
Yeah. I mean, I felt bad, rejecting my credit union loan, which was a good deal, but it wasn't 0.
That's right.
How about
That's
repossessions? How is that working for you?
it's part of the business. We are a CDFI. We lend to people who have modest means, and we know when we do that at times that people will get into tough positions where they can't keep up on those payments, and we can't work something out. And so we have to do that as part of doing business, but we just have never seen that take off to a point that's concerning. We don't see high levels of losses in those spaces. So we've got that pretty well. Just it's really baked into the overall process of, how do we make sure that we get payment on the loan? Can we work something out? Can we find a comfortable, agreeable kind of compromise if somebody is struggling to make payments? And if we can't, then it's the option of last resort. But sometimes you've got to pursue that.
Yeah, sure. It's that's the beauty of a car loan, is that it's secured.
Absolutely.
So Mitch, how do you help a credit union like ELGA increase the number of auto loans and the number of good, profitable auto loans?
So we'll start with how are we helping them in engaging their members for more auto loans. So as we shared, one of the things that we're really helping them do is focus on the right members that they should be talking to about auto loans, right? Versus just peppering the entire 100,000 plus membership with the same auto emails.
Well, my favorite is like, I get a new car and I will get like 3 or 4 letters sent by U.S. mail from local credit unions offering me new car loans. Huh? What? What? What's going on here, guys?
You've got it. I mean, that is sort of the first part, is informing Zach and team on who are the members that we should be talking to about this? And doing that again through all of that first party data that we have about them. First of all, who doesn't have loans today? Maybe that we've done some campaigns where they're refinanced, where we can see they're paying loans at other places, and then allowing them to be very targeted and focused in the message, right? The message that I give for a refi for someone that has a loan somewhere else is very different than a person that we, don't believe has a loan today. The message that we give to somebody that's, 22-year-old or a 19-year-old college or a recent college graduate is a very different kind of message that when we give to, the 50 something or the family person. So helping them be very hyper targeted in who and then what message that we're giving to those individuals is the key of what Vertice is helping them drive. But, everybody hears that and say, yeah, of course we know that. But doing that efficiently, I think Zach will share, right? They have a small but mighty team in that marketing organization, and being able to empower them with tools to say, yep, we're going to create these kind of micro segmented campaigns and create multiple versions of messaging and do that at scale is the important part, right? Again, insights without action is not valuable. So we're very focused on how do we put this into action.
Zach, so what are the metrics that enable you to say this is increasing our success?
It's really comparing the baseline of, as we go out and we communicate to a broad audience and just do a generic campaign or conversation, just kind of blanket everybody with the awareness of a loan promotion we might have going on or a current rate that we have that we're proud of, and just seeing what is our loan production and attention compared to last year's production and things that were going on, and then use that as our baseline. And then when we look at what that lift is, when we start to get more intentional and more focused on that precision targeting, do we see a lift that is meaningful? And in a lending space, that is a lift that is going to be above and beyond, a couple of extra loans, right? And we don't have a firm quantifiable number on that one. I would say that it's seeing what's material, seeing what's meaningful, and seeing what the impact of targeting different is. And is it, we got 2 extra loans that way? Well, that wouldn't be meaningful. We get 100 extra loans that way. Well, that's going to move the needle to a way that we've got to pay attention, because this has obviously been really effective. And so I don't know if we have a firm percent lift that we're looking for yet. We haven't refined our model that far yet, but it's really looking at that baseline and looking at that lift and seeing, what can we attribute to this target group that we really laser focused on, and did we see a higher propensity for them to take action and it had that result in actual business? Because the conversion is the important part, right? I want people to see the messaging and I want them to take action on that, but ultimately we want that to convert into new business.
What's the typical duration for one of your used car loans?
The loan terms are still running around 60 to 72 months.
Wow. Wow. I'm an old guy. I remember when 3 years was, and that was for a new car.
Yeah, it's crazy how terms have gone as people remain payment sensitive and rates have gone up. We see a lot of people, and I actually purchased a car last year and I was getting offers at 96 months for a term. And I was like, no, I'm good, not going that long. Thank you very much. Now, how long are people keeping those loans? It hasn't really changed. It's around 30 months or so that we actually have that loan on the books before it's either being traded in, paid off, something else is going on with it. But the term itself to keep that payment where they want it is usually running anywhere from 60 to 66, kind of 72 months. And that depends again on, age of the collateral value, a whole lot of factors there. But
yeah, I'm not going to express this in the proper terminology because I don't know it. But so I keep the car for 30 months, but I have a 72-month note. Do I owe you cash money when I get rid of that car?
Technically, sure. A lot of times, though, you take that if you've got equity in that, you trade that vehicle in, you you sell that vehicle to
Right.
the market, you've got a deficiency that you owe on that loan. Either it gets rolled into the next loan or it gets paid off from the proceeds of the sale of the vehicle. So in some way, shape, or form, if you only keep it for 30 months, you've got to pay off. You probably didn't
Yeah,
pay
I
two
would
payments per
assume
month, right? Yeah.
there's probably a deficiency if I've only kept it for 30 months on a 72-month paper. So it's it's a whole new world of buying autos. I'm not familiar with this. So, Mitch, what's your goal with a credit union like ELGA?
I would say we have two main goals. The number one goal is to leverage their data to efficiently serve the members, and two, leverage their data to drive growth. Those two things together, usually, they go hand in hand, which is if I'm serving the members more efficiently and, giving them things that they want, they're going to take those things and that's going to drive the growth. So they go hand in hand. But that's what we're really trying to empower Zach and team to do, is how do they leverage their data to efficiently serve the members through, distilling the data into insights, turning it into campaigns with targeted content efficiently, that he's not adding team members. We say we want to give you the power of a team of data scientists and a solution built for your marketing and your retail and your lending team. So we don't want to have to go add a bunch of people. We want to make the people that you have more efficient and more effective in what they do, and then drive growth. And growth is across all the products and services that you have. We talk about, go back to core cooperative principles. How do we impact member economic participation? That growth of, not just products and services, transactions, balances, all of the things that make that member more engaged and participant with the credit union is growth from our perspective.
How many credit unions are you working with, but on car loans in particular?
So I don't have a particular car loan number. I would tell you that it is a very, when Robert, the last time I talked to you, maybe it was a couple years ago, it was all deposits, deposits, deposits. Now people, the sentiment seems to be, we're ready to be lending these days. So I'm sure the vast majority, we now work with 61 credit unions of all various sizes and, across the country. I would probably say many of them are looking at auto loans for what we're doing, and it goes across all products. So, it's not an auto loan specific solution. We really are looking at all products and services and finding who are the members that show high propensity to want those products, and then help you create efficient campaigns to engage them.
I mean, as mortgages have decreased, credit unions are scrambling around looking for other options, and auto loans certainly figures on the chart. So do
For
HELOC.
sure, HELOCs, autos. Although interesting, mortgages seems to be becoming a priority again. I just saw today the rates are now below 6% on the day we record this. So, I think there is some belief that mortgage could be ticking up.
Not if you're expecting to get a 3.5% note.
Well, of course, yeah. Those days are long gone.
I mean, and as I've said before on this show, I remember with great satisfaction getting a mortgage in 2004 at 6.25%, and I was quite happy with that rate.
Right.
So I really don't understand the whining about 6%, but so be it. So HELOCs are also big now.
That's what we're seeing amongst our client base. Yep.
And you can use the exact same techniques, of course.
Absolutely. We think about, within the Vertice solution, we're essentially using all of that first party data to find opportunities for who shows the needs and wants for every product. So we serve that up to Zach and team, and then they can use it to make strategic decisions of what are the, products and solutions that they, again, what's important to the members and what's important to the credit unions, right? So they can choose to say, these are the ones that we want to engage with campaigns on. So.
Well, a HELOC, I think, would be pretty easy to analyze the market. You just look for people who've been in a house for a longish time, and you can debate how long longish is. Do a small calculation. How much equity do they have? Oh, they have a lot, so they could borrow money. I mean, am I too simplistic here?
I mean, I think at the basic level, and Zach, welcome me to weigh in. But the other things that we look at, Robert, are how do I want to engage them, right? Not just are they in equity, but do they have lots of credit cards? Do we want to talk to them about debt consolidation potentially, right? Have we seen a spike in home improvement spending, right? They've been spending a bunch of money at Home Depot and Lowe's and places like that. Are they doing home improvement? And we should be positioning it differently. So just because they're in equity, how we message it is also, I think, an important part of that. And so by understanding the behaviors, we can understand needs and wants to make a more relevant, personalized campaign to engage them.
So, Zach, what's your next frontier after auto loans?
We like to be on about 6 frontiers at once. So we have auto loans.
That's true.
We're driving auto loans forward, and we're going to continue to work through activation campaigns, right? Like we want to continue to expand and grow and be able to provide the resources and the tools that the communities that we serve need and receive value from. And to do that, there's a certain amount of growth required to sustain the technology and the offerings and the features that they're putting out there. So we can acquire new members, and that's an approach that we're taking and talking through with Vertice as well. But really making sure that we're successfully onboarding, activating people at the beginning, reactivating people who might be potentially at risk to start leaving the credit union. Really just kind of touching on all those pieces of trying to, what is successful marketing and how do we keep the communication going well and really engage people so they're taking advantage of what being a member of the credit union means. And at every one of those touch points, we have those conversations, talk with Mitch and his team, use the platform and just have that really help drive and inform what that strategy looks like for communication, for channel, for how we build out the actual targeted communication, what the messaging is like, and then start kind of working through some experimentation, A/B testing, kind of working through it and just see like what really resonates and how do we continue to get people to really engage.
I've said for years now that the issue for credit unions isn't members leaving the credit union. Because in my opinion, the only time a member leaves a credit union is when they're really, really, really mad about something. And that's not normal. I mean, I'm not saying they're abnormal. It just doesn't occur that often. The real issue for credit unions is when the account goes effectively dormant and it's just on your books. There's no fees involved in most cases. So there's no motivation. It's not, oh, hey, I have to pay Chase $12 a month for this checking account I'm not using, so I'll close it. There's nothing like that because there's no fee. It's nothing to push you out. But those dormant accounts will eat you alive over time. At least that's my theory. Do you disagree, Zach?
I don't. I agree wholeheartedly on that one. And by the time they've gone dormant too, we've already lost, right? Re-engaging somebody who's completely moved away is harder than getting somebody new, probably. So just trying to build up our strategy to be better at identifying when we're starting to lose the engagement and keep people engaged so that they can continue to see that value and want to stay with us.
Were there times when you saw Mitch's strategy and approach confusing, or you doubted that it would work?
Not personally. I've always been a person who wants to know as much as I can from a data standpoint about our members, about a situation, about a scenario, about a product that we're offering, like who's this for and how many people are going to leverage it and how are they going to use it. So for me, it was when I saw what they were doing, I wanted to and was excited to kind of test that solution in market and see if what I believed for a long time, which was if you do things with more data and you leverage that intelligence, you'll get better results. I wanted to see if that was really going to come out in practice. And I was pleased to see, and it helped kind of make the case a little bit further from an internal kind of sales point to say, this is really where we need to be going. And this is what we need to do because this is how we'll get the best result.
Did you have any opposition within the credit union to this?
I think there's always an opposition when you have a credit union that has been as successful as this credit union has been and performed as strongly as we performed for decades, that when you want to do something different and there's going to be a contract commitment to that and there's going to be a cost to it, like there's some pushback on the, do we really need it? And is now the right time? And so you get that kind of resistance. It wasn't conceptually, it was, well, that kind of makes sense, sure, but do we really need it? And should we move on that now? And so it helps to just have those wins really early on to show that it was a really, positive investment that produced.
Mitch, when you're talking to a credit union and they say, no, they don't want to do this, why do they say that?
I think the biggest reason for a no is competing for resources.
Oh, absolutely. I tell fintechs today, guys, you got to wrestle with the AI monster in the room, because every credit union is overwhelmed with AI, and you're coming in with something else, and they're going to say, "Oh man, I don't got the brains to deal with two of these things. I don't got the staff," and so yeah, resources is always a problem.
Yeah, it's the competing, they all see the value in what we do. It's we can only do so many things at one time. Why should this get to the top of the list? And so, a lot of what we're in discussions with is, why should, AI-powered personalization and member engagement be at the top of the list? And, we think it ticks the boxes that are important to them, which is, we want to serve the members more efficiently, right? This is the year of efficiency, we hear in credit unions. So we're going to help you do that. We want to grow, right? Growth is at the top of everybody's agenda. So we're going to help you do that by putting the right products and services in front of the right members so that are going to take them more, quicker. And so that's what we're really getting in front of them for. But look, the reality is there's still we're doing a core conversion, the have-tos that, we still got to do the core conversion, or we're in the throes of a digital, banking implementation, or now there's, we're doing a merger. So that takes all resources. So I think those are the things that oftentimes will jump in front of people getting started with us.
Well, the good news with this particular offering is that potentially it rings the cash register at the credit union. A lot of fintech stuff, it's not a clear transaction that, oh, I do this and my cash register will ring more. Whereas this is pretty clear cut.
So what we believe, we're going to, again, drive growth and do it efficiently. Two things that we think is important to every credit union leader out there.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey again. That's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.